Smart money concepts sounds really serious, doesn't it? But it's really just a way of looking at the markets like institutional traders. So there are many aspects of smart money concepts. But in this video, I'm going to go over four of them, which are order blocks, fair value gaps, liquidity sweeps, and changes of character. So if you're excited to learn about smart money concepts, hit the thumbs up button before we get started. And if you'd be interested in a future video going over some of the other concepts, make sure to let us know in the comments below.
We're currently on ThinkTrader, but just to let you know, if you do your charting on TradingView, then you can now connect your ThinkMarkets account on TradingView by going to the brokers section and connecting ThinkMarkets, and then you can place your trades directly from there. That could be particularly helpful if you do trade smart money concepts or you're interested in it, because there are a lot of indicators which have already been programmed for smart money concepts over on there. So just a quick note that there is a common misconception that ICT created smart money concepts. Smart money concepts was actually around long before ICT, but he's made a style of it which is very popular, easy to understand, and he's created a lot of names for some of the moves. So I am going to be referencing some of the names and the concepts which he talks about, but smart money concepts as a whole was actually around before him. So the first concept we're going to look at is order blocks. Order blocks are like digital footprints. So the way that I like to think about it is you're looking for the last doji candle before a big candle, because this shows you where the orders were. So for example, can you see that we've got a nice big long-bodied candle here, and the doji candle before it is this one. In this space here where this candle is, the one before the long-bodied candle, you can assume that there was a fair amount of orders in this price point to allow for this big move here. So the idea is that if you mark it up as an order block, the market may come back to that point in the future and you can look for potential trades. So to do this, I use the rectangle tool on ThinkTrader. So if you look along the side here, sometimes you see it's got a paintbrush on it. If you click here and then go down to rectangle, what you can do is you grab the top of the doji candle before the long body candle, and then go to the bottom of it and you just drag it along. And if you click on it, you can see it says add text. You can just write order block, so that you know what it is. So the market hasn't actually come back to this point yet, and it won't necessarily ever come back to this point. But if it does come back, then you know that this is a point where you might be interested in looking at a potential setup. Now, just to make a point, we are on the 1 minute chart now, but you can actually do order blocks on different time frames as well. So I'm just going to get rid of this one for now. And let's just go to the 15 minute. So we're just on the 15-minute chart here. And can you see that we've got really long bodied candle, this one here. So that was obviously when the market opened. We've got a little doji candle before it. So if you grab the rectangle tool and you draw on the length of that doji candle, drag it across, can you see that this has become a point where the market uses it like a springboard to bounce back off again? So this is a potential place where you might want to look for a trade setup. The next concept we're going to look at is a fair value gap. So the idea of a fair value gap is similar to an order block. It's just a different way of looking at it, and there are some slight differences as well. So a fair value gap is when the market makes a very big move very quickly and it leaves a lot of space. And that space becomes like a magnet to the market. And the reason for that is because the move happens so quickly, sometimes it might have missed some price points along the way, on the way up, for example, if we're talking about a fair value gap that's bullish. And that's because if it moved so quickly, some of the orders were so big, it kind of skipped some of those price points on its way up. That then becomes a magnet for the market, because the market is geared for efficiency and therefore it wants to come back in. It wants to take as many orders as possible before carrying back on up again. So for example, a time when you might see a fair value gap is if there was a huge piece of news that came out, the market shot up really quickly, and then you see a bit of a retracement back into that first long body candle, and then it continues back up again. So basically, if you miss that first big move, Don't panic, draw up a fair value gap and see if the market comes back to that price point. It gets you a much better price as well than entering at the top of the big move that happened, and it means that you get a much better risk to reward ratio. So I'm going to show you an example. This is a big move which happened due to a news release. It was an interest rate decision, and how you draw on the fair value gap is you're looking for the top wick of the candle before the big move and the bottom wick of the candle after, because this is the point where there are potential gaps. So again, we use the rectangle tool, and can you see this is the candle before the big move and this is the candle after. So we go to wick to wick. So I'm just going to drag that across and then show you what I mean. So can you see how this is the top wick of the candle before and that's the bottom wick of the candle after? So what happens is the market makes a move up and then it comes back down, fills the gap, and then carries on going back up again. So if you miss this big move up and you want to wait for a better risk to reward ratio and a better price point to enter, you would be looking for a position within the fair value gap. The next concept we're going to look at is a liquidity sweep. So this is a classic stop hunt situation where the price grabs loads of orders and then goes in the real direction it was going to. So if you're quite new to trading, this concept often is unbelievably stressful until you understand what's going on. What often happens is the market looks like it's going in one direction. So it's quite common for new traders to get excited, jumping too quickly, but really all it's doing is having a liquidity sweep before going in the other direction. So just a little example that we have here. Can you see how we have the low of the day was set down here, this little point here? I'm just going to draw on a little line to show us the low point. So this is the low of the day. Can you see how the market breaks the low with a wicky candle, but then shoots back up again? So this is a classic liquidity sweep. Liquidity sweeps loves the low and the high of the day, of the session, of the week. So drawing up the high and the low of the previous session, of the previous day, these are great ways to find places where there may be a liquidity sweep. When the market came to this point, it probably looked like it was going to break down and crash down and keep going. But really all it was doing was just grabbing the orders and then carrying on back up again. And the final element of smart money concepts we're going to be looking at in this video is changes of character. So this is the first sign that the market may be changing trend direction. When you look at market structure, you're always looking at the swing high, or the highest point, and whether the market's making higher highs and higher lows, or whether it stops making higher highs and starts making lower highs. So what that means here, can you see on this way up here, at this point, this was the highest point, and this was a little swing low there. Can you see how the market breaks this point here, and we have a higher high? And then when it comes down here in this little pullback, it's a higher low than this previous low. And then it goes back up again, and now this is the highest point. It was a higher high than this high, which was a higher high than this high, and this low is a higher low than this low. So those are the sorts of things that you're looking at to see that the market is continuing in the way that it's going. But when you start to see that the market stops making higher highs, can you see up here, this is the highest point now, and it's not making higher highs now. It's now making lower highs. And can you see when the market has this candle here, it breaks these low points. So the low here is lower than the previous lows. So that is the first sign that we've got a change of character. It means that the market may not be continuing up anymore, and actually we may be starting to see a bit of a downtrend.
So now you understand some of the basics of smart money concepts. If this appeals to you and you'd like to try implementing this into your own trading routine, then make sure to practice anything new on a trading simulator first. You can use the Traders Gym at ThinkMarkets. It allows you to practice any new theories or ideas or concepts whilst using virtual money. And if you got some value out of this video and you found it helpful, make sure to give it a little thumbs up. Also, let us know in the comments below if you'd like to see a future video going over some more smart money concepts.